Hopefully you're finding this opportunity to actually network with other GBA members to be of value to you. I know that I personally do. It is nice to not only see all the new faces that are a part of this particular conference, but also the friends that, or people who've become friends that I've known now for a number of years. But for our next topic, we have a discussion between two people. This is Mark and Stacey are going to sit down to discuss the proposed accounting standards over crypto assets, the current state of crypto accounting, and the Fair Value Project. This is a discussion on crypto issues in crypto accounting. Please. Yes, excellent.
All right. Accounting is not something you normally see people. Is this on? Keep going.
Is the button red or green?
Green light. No.
Test.
There we go. Oh, now it works. So accounting is not something you normally see people talking about at blockchain or crypto conferences. So hopefully we won't be putting you to sleep. But I'm really excited to be sitting down with Markus Veith. He is the partner in charge of the blockchain and crypto assets practice for Grant Thornton, assisting a lot of Web3 companies. Myself, I work as a forensic accountant with HKA, commercial damages disputes. But my second job, like most millennials, I have two jobs, right? My second job is teaching at the University of Maryland, where I teach in their Masters of Accountancy program, a course on blockchain and digital assets. So educating the next generation of people. And I just want to make a brief plug that I'm putting together a crypto night for crypto accounting. If you are wanting to recruit accounting students or young interns, find me and I'll exchange information. With you. I get a little nervous when I first sit down on a stage. So.
Great. Thanks, Stacey. So, again, Markus Veith, pleasure to be here today. I'm a partner at Grant Thornton. Grant Thornton is like one of the largest accounting firms globally. We do audit, tax advisory. And how do I get to crypto as an accountant, right? My background is banking. I was trained as a banker, worked as a banker, audited, advised banks, and then suddenly in 2014, our firm had the great idea, or one of our leaders at our firm had a great idea, hey, why don't we work with a crypto company? And there was like some personal relationships. One of our senior leaders was good friends and former colleague with the audit committee chair of that company. So that was at a time in 2014 when none of the large accounting firms would have been willing to work with crypto companies. So we made a concerted effort. We said, look, how can we address the risks? How can we get comfortable with what everybody considered like a risky industry? So we found people in our forensics practice that have blockchain experience. We set up our own fully synchronized nodes, which also set us apart from other firms, smaller firms that use like public block explorers to look up transactions. So we maintain fully synchronized nodes of all the blockchains that we support. And I had to get from zero to hero in a year because I didn't know much about crypto and blockchain. But we've grown the practice. We've worked with some of the largest companies that are out there. I mean, of course, the last year was not an easy environment with some of the cascading event, right? That first took down Terra Luna, then 3 Arrows, and then like the crypto lenders, and then culminated in FTX. So from that perspective, we are committed. Grant Thornton is committed to the digital asset space. We did, of course, a risk assessment, risk refresh, and again, we're committed to the space. We're not exiting like some other firms are doing, but of course, we have also rigorous standards and protocols that have to be met if we onboard clients.
Absolutely. So you mentioned 2022 and the regulatory the lack of regulation and the lack of standards, and one of the things that I cover with my students is that people don't want to talk about it, but accounting often underpins the ability to have good financial information, and that good financial information enables all our markets to work. And in the blockchain space, you often have people saying, well, we have blockchain, right? And so we have all the ledger, we have all the transactions on the ledger. But as was pointed out in one of the earlier panels, most Web3 companies do not have their accounting on a blockchain. The accounting still happens in traditional ledgers off-chain. And so, fortunately, there's been a lot of innovation around like how to get that information, with crypto subledger account software in terms of getting information from a blockchain into a general ledger, into financial statements. But one of our challenges has been we didn't have an accounting standard, right? There was no guidance on, well, how are you supposed to report this? And, as accountants, we love rules, right? We love rules. And so without rules, it's kind of like, well, what are you supposed to do? So one of the things we wanted to discuss, obviously, here is the FASB, which is the Financial Accounting Standards Board. They are the entity in the United States that promulgates generally accepted accounting principles, GAAP. So US GAAP gives us all of the rules on how to account for different things. And they are now in the process of creating a standard for fungible crypto assets. And we wanted to talk about that exposure draft that they've put out. And we're expecting we'll have an accounting standard for crypto assets by the end of this year, which is pretty great. It's going to be a big jump for helping more traditional entities and other people who've kind of stayed away from crypto feel a little more comfortable about entering the space. So the FASB standard, it has opted for fair value, and I know that you've long been in favor of fair value. Most people have been in favor of fair value. Any comments on that?
Yeah, no, thank you. So just taking a step back, right? For the longest time there was no guidance, and I think just 2 or 3 years ago, the FASB had on their agenda again accounting for digital assets, and it was voted down as not being a pervasive issue. Yet, you don't have clarity. So when we entered the space in 2014, right, we had to make do with existing standards, and back in it, nowadays you also have to keep in mind the EICPA has a digital asset working group. I'm on the audit side. Some of my colleagues on the accounting side, where basically best practice and guidance is being put out, and so back in 2014, right, we had to say, how do we account for it? And we kind of like compared it and analogized it to inventory. So if your business model was that of a broker-dealer, we said you could get to like, as a private company, to fair value treatment. However, then over time, as the EICP working group was moving forward with recommendations and putting audit and accounting guidance together, it became, and also the SEC made it very clear that as a public company, you have to apply cost basis method, so you could not account for your inventory at fair value. That's kind of caused initially a shift between private and public companies, and then again 3 years ago, when the FASB said, "Oh, we're not going to pick up a project," but then like over the last 2 years, they changed their mind and started to survey accounting firms, and we also had informal meetings with the FASB where they surveyed all the large firms and said, "Hey, what clients do you work with? What are the challenges from an accounting perspective? Fair value, does it make sense? Does it not make sense?" So we, of course, had a good conversation, and then finally the FASB decided to put forward an exposure draft to move the accounting on a fair value basis. There are certain exceptions, right? So I think you mentioned already,
right,
it has to be fungible.
The standard excludes wrapped coins, it excludes NFTs, non-fungible tokens, and it excludes native tokens.
Correct.
For the issuer, from the issuer's perspective. And I think we were going to talk about why would it exclude those things. I mean, non-fungible tokens to me seems like an obvious one. So for anyone who's in the audience going like, fair value accounting, what does that mean? Fair value accounting, in short, is also sometimes called mark-to-market. And what it means is that on my financial statements, I will record something called an unrealized gain or loss, meaning that I haven't sold this stuff yet, but if I were to sell it today, this is what I would realize as my gain or loss. So you get to put that on your financials, right? And that's useful for if you have so that's the kind of accounting that's used for stocks and investments and securities. And it's used because it helps the stakeholders and the people who are reading those financial statements to understand that where your business is. And it also allows them to see well, maybe you bought something really cheap, but now it's really valuable, right? So it can help them to see the value, the actual market value of the company's assets. Yeah. NFTs, they're excluding because NFTs represent claims, enforceable claims on underlying assets. Is that correct?
No, I think the reason why NFTs are excluded are because they're not fungible, right? Because one of the requirements in the exposure draft is that the asset has to be fungible. And an NFT is a unique type asset, right? One Bitcoin is like another one, right? You can have two Bitcoin that are same. We can exchange them as the same value, same type.
Yeah, a question then is, how do they account for things like art or other tokenized items that are not cash related or currency related? So how would you deal with things like that?
Right. No, thank you. So, I mean, just taking a step back, thank you for explaining the fair value concept, right? Like in a securities environment, securities are typically, if you're a trading firm, right, accounting at fair value, right, ups and downs, you record the change in your income, in your P&L. Digital assets so far, and specifically when the SEC came out and said, as a public company, you have to record them at cost and measure them for impairment. It means, let's say you buy a Bitcoin at 100 as a public company, but that recommendation has been now translated also for private company. And I'm just talking about where we are currently before the exposure draft comes into play, right? So cost basis means you buy a Bitcoin at 100, and then the price goes up to 120, doesn't do anything, you keep it at 100, but a price goes down to 70, you have to write it down to 70, price recovers to 100, you keep it at 70. Like cost basis and impairment measurement means down, 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 but never up, right? So you could have there's been debates, right? You have a flash crash one night, price crashes down and it recovers almost instantaneously, right? There's a widespread belief that you would have to mark it down to the crash price, but you cannot mark it up. So the question that you ask, most digital assets are considered, for accounting purposes, intangible assets. And the accounting standard or the accounting practice for intangible assets is the cost basis, right? So now that the FASB has come out and said, we want to change this, and digital assets have been, I don't want to say carved out, but certain ones that are fungible, you will be able to market them and recognize, right? Like the Bitcoin you buy at 100, on a going forward basis, the price goes up to 120, you mark it up to 120, you take the 20 into income, price goes down to 70, you mark down, you take the 30 or the 50 as a loss, and then it recovers again to 100, you mark it back up, right? The ups and downs would be reflected in the P&L.
Mark-to-market.
Yeah, but the coins that you're describing, I don't think they meet the fungibility or also the goods and services requirement, which is another aspect. You would have to continue to count for them at cost basis as an intangible asset. And again, NFT, the reason is they're not fungible.
My personal opinion, and I need to clarify, it is my personal opinion, it's not actual guidance. Most NFTs are tied to an underlying asset, and there's existing accounting guidance for most of those types of assets, whether it's a real asset or if it's some kind of digital object, it's an intangible. And so, we don't have guidance on NFTs, probably in large part because you don't really need new guidance for NFTs because of that connection to an underlying asset or service.
If I may, please, I have 2 questions / comments. So,
are you going to give me that money?
yes,
That's
there are the 2 $20 bills. Question: are they fungible?
Yes.
Can you trade one for another?
Yes.
Well, they have the unique numbers.
Exactly.
identified.
They're not fungible. They're what's called degenerative. They have unique ID numbers. So let's keep that in mind. And the second,
But still, a $20 is a $20 rate.
Well, you can buy the same amount of
Yeah.
goods and services, perhaps,
Right.
but you can't necessarily exchange one for another unnoticeably, right?
I can load it on my debit card or use a credit card, and then the dollar is fungible.
Cash.
Yeah.
And then the second question, when you talk about mark-to-market, you are assuming that there's liquidity depth enough for you to actually be able to sell. How do you deal with that? Thank
So
you.
Yeah.
that's very interesting that you bring that up because I have been working with crypto CFOs. It's a group of finance and accounting professionals, and we've been crafting a response to the exposure draft questions, right? And that came up a lot in our discussions. And so we have, in our answer, we're going to ask the FASB to address illiquid altcoins. We are asking that they require illiquid altcoins. So either, look at market depth or your tokenomics if they're overly restrictive. We believe that there needs to be some kind of a disclosure about illiquid altcoins. You need to separately disclose them, and you should only, in our opinion, report them on your balance sheet at the realizable value. Right, exactly. So in that case, you would also be, there's an accounting standard about, levels of fair value. And so that would be a level 2 or a level 3 input if you have like a really shallow market depth and the quote you get on, I see some of you like holding your heads like, oh, this is getting really technical. But if,
As long as we're not quoting the standards, right?
Yeah.
You see it.
So if you go to a like coin market cap and you look at the price and you see that plus 2%, minus 2%, and if it's a really low number, like let's say it only takes, $3 on a really obscure coin, right? $3 means you can move buying or selling $3 means you can move the market by 2%. You can move the price, by 2%. So if someone was to, let's say, have $1,000 of it, and they wanted to sell all of it, as they sell, the price is going to start tanking. And so they're not actually going to get $1,000 for it. They might only realize as they sell it, maybe $600 or $700. And if there's tokenomics laid on top of that, and they have like 30% fees that they have to sacrifice when they sell, then you're looking at even less that they actually realize. That should not be put on, in my opinion, should not be put on a balance sheet as I've got $1,000.
And it's interesting, right? That question, that point, the FASB left out the fair value specific guidance from the exposure draft because saying, well, if you look at the guidance that covers fair value basis accounting or that explains fair value and how fair value is determined, there's already existing guidance, right? So you don't need to embed guidance in that digital asset accounting exposure draft. They refer to the existing standards, right? And as you said, it depends on, but it's the same with security, right? Like the same standard will govern securities and digital assets from a fair value perspective, right? So if you have a less liquid security, sometimes you have to take discounts, when you know that like a sale will move the market or other aspect. And it will be the same thing for less liquid coins. So they kind of like left it, I don't want to say ambiguous, but purposely left that aspect out of the exposure draft. One thing I also wanted to mention what is excluded and why I like tokens with enforceable rights are excluded, and unfortunately there's no clarity on what the definition is of what's an enforceable right. The other challenge that exposure draft is also recognition and derecognition has not been defined, right? Like when do you recognize, when do you derecognize, right? They're also deferring to other standards. And that goes back with the own tokens, right? Because own tokens, utility tokens typically come with like an enforceable right. That's the
You're talking about native tokens?
Yeah. That's why partially they have been excluded. Yeah.
We've been kind of speculating in our group about whether or not native tokens are excluded for the issuer. They're not excluded for a third party. If you buy a native token, you still would follow this accounting standard, right? But if you're the issuer of a native token, so we've been speculating, and I'd like your thoughts that perhaps the FASB is looking at this as a kind of modified equity in a way for that issuer. It's almost kind of like their stock shares or like a form of crowdfunding.
Yeah. Thank you. Not want to go into like a conspiracy theory here, but I mean, own issue tokens have proven problematic over the last couple of months, right? You think of FTT tokens.
FTT, yeah, right.
That's what the FTT token was. It was issued by FTX, was an equity-like instrument, and the idea was the better FTX does, or the better people thought FTX does, the higher the value goes up, right? And I mean, if you think about it, right? I mean, I open a company, I issue my own token, and just sell it and record revenue, right? I mean, that's also the model for some other coins, and that's why the FASB is also reluctant to say, yeah. Not saying, look, we endorse companies creating their own token and recording revenue, because that's not how it works, right? You create a token, you sell it. Should it be revenue or not? That's also another debate.
It acts like equity in a sense, so you would account for it in a different way,
Yes.
because you can't just say like I'm creating money out of thin air, which unfortunately that's like probably 80-90%
Right.
of the cryptoverse.
And it's also the Ripple case, right?
You are well. You're taking fiat in return for
Yeah.
your
But
created.
it's also what Ripple
stuff.
is doing, right? Ripple has sitting on billions of dollars of Ripple. I think you were first.
I had a question.
Yeah.
How is it creating
Oh.
equity? Sorry. I had a question. How is it creating equity?
So because the coin is tied to the reputation of the company, right, and how well the business does, and so in that sense, it's not. By the way, there's no standard, there's no rule that says it is creating equity, but it's acting like equity. It's acting like stock shares behave, right? It's acting like bonds behave. Like the FTT token, for instance, its value was very much tied to how FTX and their reputation.
Where's the microphone? I have another follow-up question. Okay, so if it's acting like equity, is it acting like a security then, or is it a commodity?
Now,
Because
that's a legal determination.
Because a token, again, in my personal opinion, is more
And- and-
commodity-like. But I mean, if you are going to be defining that has a whole nother area of.
And being in equity does not make it a security necessarily. That's a legal question.
I know.
And I've worked on articles with the Journal of Accountancy and the AICPA, and it is not the accountant's place to make legal determinations. Okay? Limitation of liability.
I mean, just in response, right? I mean, it's the right point to say it's a legal determination, right? I mean, if you just follow the statements made by Chairman Gensler, right? In his mind, everything but Bitcoin
Everything is a
may
security
be a
for him.
security, right? And there's also, of course, always reference to the Howey test, but there's no clarity, right? If you ask the SEC, they says there's clarity. If it's not a Bitcoin, maybe want to register, right? It's again, it's a legal determination, not up to the accountants, and it's an interesting topic. I believe you had a question, right?
Yeah, one point of contention, and then a question. So the point of contention is that those two $20 bills were fungible. You know, Latin for fungi, separable into many parts. There's 20,000 units in those, or there's in those things. So you can separate in the dollars and in the pennies. But so the question that I have is, so if I get stock issued to me from my companies, I'm an advisor to multiple companies, I get stock, I can fill out an 83B and take that election, pay taxes on that initial stock price. Am I able to do that same protectionary mechanism in reference to taxes when I get coins early? And then also too, how do I remain compliant when with AI trading large sums of tokens daily?
Sir, I know some very good tax accountants that I'm going to put you in contact with, okay?
Right.
You are talking to a forensic accountant and an auditor.
I mean, the one thing I can say is every time you sell a crypto, it's a taxable transaction, and in theory, right? Let's say if you go and buy a coffee with Bitcoin, in theory, it triggers a taxable event. In theory, right? I know there's just currently a proposal out on.
Well,
Yeah.
if you're not treating crypto like money, then it's a lot of legal definitions that the regulation needs to work out how they're going to define something. And once they define something, then we'll have better rules. In the meantime, you let me know if you need that tax accountant, okay?
So I have a specific example here, and it's actually one I have to deal with. You missed one class of tokens, and those are semi-fungible tokens, where there are a certain number of identical tokens which are fungible, and they aren't changeable with others. And specifically what these are imaginary playing cards. They're used in a game. They have no backing whatsoever. They're just intrinsically valuable. They can be valued thousands, tens of thousands of dollars. So when you're doing profit and loss statements, how exactly are you doing cost basis on that? Because what I've always done is just the cost to acquire.
So for a semi-fungible token, I'm addressing this in the next Journal of Accountancy article that's introducing a digital asset taxonomy, which I'm proposing for here's how we should think about digital assets universe. Semi-fungible tokens, what I've looked into and seen of them, they're always tied to some kind of a digital object, right? It's a playing card.
It's a playing card.
So it's not a fungible crypto asset. It would not be covered by this particular. I know
But
you're
it
going
is
to disagree with me,
fungible
but
with a bunch of others that are identical to it, semi-fungible.
so I consider these to be NFTs, and they are. It's a combination. The whole collection has a combination of both single-use NFTs and reusable NFTs, which are two categories that I've come up with, honestly.
Well, just
Where the
imagine-
fungible tokens in that collection, if you buy it once, you spend money on it, and then it doesn't really have resale value, then it's
There's a market. They have a
And if there's-
constantly saleable
Yeah, and so for the
resale
ones-
market, and it is liquid.
But I would say the coin you described, right, without knowing further details, I don't think it would meet the definition for the fair value, for the token that are subject to the fair value treatment and exposure draft. Because you have that goods and services, right? There might be an enforceable right, it sounds like, right? Because if it's a gaming card or something, there's something to it, right? It's not just like, oh, it's a token, it goes up and down, but, why would I buy the token,
Right, each card has different value,
Yeah.
and they're not all equal to each other, even though they might be identical. It depends on like
Imagine
maybe
that a
the
Magic
design,
card
who
deck
owned it.
just became
Yeah.
virtual. That's exactly what it is.
So it's a type of NFT, and you would account for it based on your cost for it. You would probably account for it as an intangible asset.
Yeah. And I know we were going to talk about the
Unofficial, just my opinion.
Yeah.
Okay.
I know we were going to talk about the cost base. Is it okay if I address it now, or
Well, we've got 2 minutes left. I don't know that we're going to have time to talk about cost basis, but were there any other questions? Yes.
Well, first of all, thanks for the GBA for having this topic featured here. My name is Greg Johnson. I'm with Rubicon Crypto and New York University. I would argue that if you do believe in conspiracy theories like Choke Point 2.0, that the audit function and the lack of audit capability is one of the most pressing crises that our industry is facing. What advice would you give us as mouthpieces to the industry to go forth as a kind of a, where do we go from here? How do we raise better awareness? What's the solution in your view to this constriction of audit capability that is strangling the industry silently? Thank you.
I saw a meme that showed Sam Bankman-Fried and it said, "Don't be this guy, do your accounting." So
I have that sticker.
my advice would be don't use QuickBooks for a massive company. Hire an accountant, hire a CFO.
I didn't work for FTX.
But there's also lots of crypto subledger software that is already built to handle blockchain data and to do all of the accounting pieces for you. So just like don't neglect. I know it's dull and it's tedious and it's not exciting. There's lots of rules and it can be kind of stifling, but just don't neglect that piece of it.
Again, right, I'm part of the AICPA Digital Asset Working Group on the audit side, and we're currently putting like an updated guide together. And one of the recommendations will be that accounting firms that audit crypto companies should have their own synchronized nodes. They should not use block explorers or even rely on third parties, right? I mean, that's like something, as I said, we did that's the route we went from the beginning when we set up our practice. We said that's the only way for us to get comfortable from a completeness and accuracy perspective, because we noticed our nodes had sometimes different values than if you look up the node on a block explorer.
Are you developing CPE credits as well in a category of those to kind of advance things?
We do, yeah. I mean, we do training, yeah.
All right, so even though the clock has said that it's 0, can you give me 5 minutes on this clock again? Because I'd like to actually have a few more questions. I think this has been very interesting because we've had a lot of engagement from you, the audience, with the panelists. So if there's 3 or 4 more questions, Eugene, you've had your share. So
Maybe the back.
Well, you can. I'll take a question if you'll give me the $20.
Wait. You can have one of the 20s. I get the other 20.
See, I gotta. Yeah. Oh, yes.
It was a contribution. Yes, please. Wait. Where's the microphone? I'm sorry. We'll get back to you, I promise.
Yeah, I'd like a follow-up. Could you go into a little more detail on the differences you saw between your own nodes and the Explorers?
Yeah, I mean, I'm just full disclosure. I'm an accountant. I'm not on the blockchain technology team. We have like our forensic teams that runs the nodes, and right, our nodes. I guess we sync them up, right? So they're live. And my colleague told me that when they looked at the value in our nodes versus what they saw in public block explorers, there were sometimes differences, because we had the challenge when we had like some clients that were giving us values and we had differences, and then it became clear that they looked up on public block explorers versus what we saw in the nodes. So I cannot give you the details. If you're interested, I can connect you with my colleague and we can have a conversation. But this is a real, I don't want to say issue, but something we've experienced, because it's like a timing lag, right? It's a timing issue. It's not like, I'm not saying like public block explorers have made up numbers. That's not the case. It's like a syncing up to the live data issue.
Well, you would always have that when you have to have the sync between any of the nodes, because you don't know which block your particular node is on, and if there's a correction to the the extension of the chain. So, yes, go ahead.
Hey, thank you very much. So I don't know at all if there's any accountability or the interactions between the IRS and the SEC and so on and so forth, DOJ. Oh, I'm sorry. Can you hear me?
Yes,
Good.
go ahead.
Okay.
Continue.
So in the wake of the FTX contagion, the Celsius network meltdown, the CeFi meltdown in general, the people have lost their life savings. And for some states, for example, they're still being demanded to pay taxable income on both principal and income generated within the tax. I am one of those people. I went from riches to rags. I'm now homeless as a result of the state's inability to recognize that a tragedy occurred, and now lawfully in the 4th District, what happened is they legally owned, whatever that means, the property, the rights, the usage of, our tokens. And so we are angry at the SEC for not having categorized them so the tax code can keep up. What do states do who don't recognize federal, let's say, capital losses in order to offset their gains? And what can be done from a federal level to provide relief for people who find themselves on the street as a result of New Jersey's Bureau of Securities' gross oversights as to their evaluation of how they were generating income, validating the fraudulent claim that they had made, which had convinced me and many others prudent in investing to invest in that Celsius network. Thank you.
Well, first off, I'm so sorry to hear that's happened to you and the struggle that you're in. Well, yeah, but still, that is a difficult position to be in. Those questions are currently getting settled within the courts and between those different agencies. And I mean, we're just as much spectators as you are to see how it all plays out and falls out. Obviously, the accounting standards entities, we're doing everything we can, and those crypto accountants and people who are knowledgeable of it, we're doing everything we can to try to have good standards, fair standards that are going to bring some more transparency to the area, and hopefully hopefully all of this mess will result in much more clearer pathways for justice and for people to get what belongs to them, and for the blockchain records to be treated as valid and proof of ownership.
I mean, just one thing to add, right? I mean, in the course that, I attended a couple of restructuring type events or conferences, right? It's the interesting question that nobody had probed before is like, when a company like the one you were a user of files for bankruptcy, right? Do you have a claim to the coins, or do you have a claim to the company, right? An unsecured claim. Right, of course, then everybody throws out a frame, not your keys, not your coins, right? And I think we're going to see we've seen a big push to self-custody, right? That, no matter what's, sorry, just add my perspective, right? I think from a regulatory perspective, if we get comprehensive regulation, we're probably going to see a similar movement what we see in Japan, right? Like, you got to split the trading, the market making, the custody, settlement in different entities, that if something goes wrong, that the activity is more treated like, like a true custody or security business. They say, look, company goes bankrupt, they need to have the customer's coins safely and not commingled, right? The commingling is also an issue. And sorry, just one last thing that I wanted to say actually at the beginning, what people don't recognize, or oftentimes, many of you probably know, but if you think of like a crypto company, right? Large crypto exchange, 95% of the transactions do not hit the blockchain. It's all within the internal ledger system, right? When we audit like a large exchange, some of my colleagues said, oh, every transaction is on a ledger. I was like, no, you have on-off-chain reconciliation, but 95% of the transactions just, that makes a crypto company that everything is a crypto company more like a traditional CeFi than a what people think is a blockchain company.
Yeah, hopefully what comes out of all of this is there's more consumer protection, because we definitely need it, to encourage people to get together. Yeah.
I think we need to get together, and there's been no relief effort on behalf of the public sector, on the private sector leadership. Like, I wag my finger at everyone reporting something new right now in the private sector, not coming together and standing up and saying what happened was malfeasance, intermingling. We had the reporter, I'm sorry, thank you. The court-appointed examiner, Ms. Pilar, former DA, and she proved the commingling. We pushed her in the direction of showing that there was, let's say, prospective embezzlement and where exactly to look. Exactly to look. And so there's a criminal enterprise being represented as if they should have the protections afforded by Chapter 11, while people are literally by their own states being driven to homelessness, to right now as we speak. So all I'm saying is, and I'll finish on this, who here has spoken up and said a thing? And I'm just going to say we are available to make some noise. And noise ought to be made, because this is some of the most gross injustice in my lifetime, and it made me lose so much faith in our regulatory apparatus. I invested based on New Jersey Bureau of Securities and their evaluation of their books. That's why I invested in Celsius Network, which shook everything.
We actually have to be moving forward. Thank you, Stacey. Thank you, Markus.
Thank you.